Hey friends, welcome to Gale.in. Today we'll be learning about options. So this will not cover the very basics of options. Let's get on to it. So today we'll be learning about advantages of buying and selling options. Which one is better for whom, and how should you get oneself prepared if you're going to buy options or sell options. Things to know before you go through this video, like very basic understanding of future and options. Should just know what is call, what is put option, what is options mathematics. Option, if you know what is options, then I can explain you. The option of a strike price, either put or call, has a premium. Along with the premium, there is the difference between actual market price and the selected strike price. So this premium, which is included in this option value, is based on the time remaining for expiry, and also it includes the probability of the market price to hit the strike price. So the premium which is included in this option value always decays to zero on expiry date. So this is the screenshot from NSE India website. So you can see Nifty expiry date, what is the type, you can see the strike price. This is the actual options value, the change for the day, this is the volume traded, and this is the value, this is the open interest, and this is the underlying value of the contract. So this is the Nifty price in options. Like you can see, this is the Nifty price. The nearest put option is 9900. So you can see the difference between 9900 and 9914 is 14. So you minus 112 from 14, the premium is 98. So this expiry date is 18th. So this 98 rupees decays to zero if this market ends at 9900. So if market ends at 9900, this 98 rupees decays to zero, and also you lose this 14 rupees. So in total you lose this complete 112. So what happens is every and also you can see the call option. So 9900, you can see it at 100.5. So 100.5 minus 14, you get 86 rupees. So 86 rupees is the premium that you're paying for the call option. So if this Nifty expires in 9900 on 18 June, so you lose this 100 rupees. So you lose the premium of 86 rupees that you have paid, plus this difference of this 14 and 990. So you lose this 100.5 rupees per contract. So every 100 rupee difference, you can see the premium like half the value. So you see 9900 call is at 100. So you can see the call of 10,000 is almost like half of this. Then call of 10,100 is half of this. 10,200 is half of this. You can see it's half the value. So that is how the options value lies. So this option, this premium of 98 rupees on the put and 87 rupees on the call, it is based on the VIX index, India VIX. It is the volatility index. Like if the VIX is above 30, it means that the stock market can move plus or minus 30% in next 1 year. So this 98 premium points, you can also calculate the volatility based on the ATR. If the ATR is around 200, so in 2 days, if the stock market is moving in a single direction, the Nifty can move like 400 points, 200 plus 200, 2 ATRs. So that is the reason the value of the premium is so high due to high volatility. Uh, so we'll not get very deep into this. let's finish this presentation first, and let's see what value we can add. So what is buying options? So it is also called as retail trap or a lottery for retail investors. Why it is so called? Because the capital requirement to buy per a single lot of options is less. You just need to pay this uh, last traded price into a lot, like 75, the 75 the lot of the Nifty. You can see the call of 10,300. Just need to pay 7.8 into 75, closer to 500 rupees. So if you have 5,000 rupees, you can buy 10 lots of this contract, but the underlying value of the contract is 10,300 into 75, which is 7.5 lakhs into 10. You can see 75 lakhs. So you're almost buying a contract value of 75 lakhs with just 5,000 rupees. So the risk involved is very, very high. The capital requirement is low per lot. Profit can be in terms of multi-bags, because with 5,000 rupees you're buying contracts, underlying contract value of 75 lakhs. Even if you make kind of uh, the market is able to move the complete 400 points, like 2 into 8 years in next 2 days. If market closes at 10,400, you could almost get like 5 to 6 times the value of this uh, last traded price. Not just 5 to 6 times, even 10 times. So the probability is very, very low to earn money in this while you buy options. So let me tell you. So you can see the call value of 10,300 is 7.8, and put of 9500 is 21. So you can see if a person buys this 21.65, another person buys this 7.8. Either one of them is uh, going to completely lose their money for 100% sure. And there's probability that closer to 95%, or can keep like 85% that both of them lose the complete money, because this premium can expire to zero. What happens is, you can see this, out of these many options, only 1, 2 and 3 have traded positive today, and remaining all, you can see the decay happening already. So most of the options end in zero on expiry. So if you have a good trading skill, and you enter at the right time and exit at the right time, like within if you're able to capture like 100 points in let's say a day, or not a day, in less than 2 hours, if you're able to capture 100 points, so you will be easily doubling your money, closer to double. You can earn up to 80% of your money invested. Let me explain you. So you can see this 9900, it is trading at 112. So as the day started, the Nifty was closer to 10,000. So when the Nifty was closer to 10,000, you can see the put price of 100 point difference is at 71. So put 9900 was trading closer to 60 to 65, and now it is trading at 112. Like 100 point move in a day is almost double your money. So this is kind of returns you can expect. So if you're able to capture this 100 points technically within a day, you can double your money. This capacity to double your money increases closer to the expiry day. So on an expiry day, if you're able to capture closer to 100 point swing in Nifty in less than 1 hour, you'll be able to make 6 times the money, almost closer to 3 to 6 times. So selling options. So the capital requirement per lot is very high because the underlying value, you have to completely pay the underlying value. So the underlying value is 10,000 contract is 10,000 into 75, which is 7.5 lakhs. So you need not pay the complete 7.5 lakhs. You can pay uh, closer to 15 to 20% of this, closer to 1.3 lakhs you need to pay. So uh, here this is minting. I call it as money minting machine because you can see most of the options expire to zero. So if you have some basic F&O open interest data, if you're able to read and basic training just to understand the FII buying and selling on day-to-day basis, you can fix a range between which the stock market can move. So currently we have fixed the stock market to move between 8,800 to 10,800 in medium term, and 9,500 to 10,000 in shorter term. So what you need to do is just sell options out of this range, like 9,000 contract you can sell, and 10,800, 11,000 contracts also have some value. You can just need to sell them. So once you sell them, the probability of market going below 9,000 or closing above 11,000 is uh, less than 1%. So you can earn this money completely. So the lower the returns you're trying to expect, the higher the probability to get that money. So you can, if you have good capital, you can always try to sell options and gain money. So how HNIs use options? What are the basics? Option use of option is like if you have a portfolio of 7.5 lakhs and you buy a option of 9,000 put for 5 to 6 rupees or less than 2 rupees. So you just pay 1.35 lakhs and buy this option at 2 rupees. So what you need to do is if market crashes below 9,000 due to sudden event, so market goes to like 8,000. So what option gives you is like 2 rupees, you have earned like 10,000 rupees, like 1,000 rupees, 1,000 into 75. So 75,000 rupees you will get. So if market crashes 10%, 20%, you get the money that you've lost in your portfolio. Instead of losing money in your portfolio, you just get the money from the options. You can use the money to buy stocks in your portfolio. This is the actual reason or actual use of the options. So it is kind of insurance for your portfolio. So if market does not crash, like if the market does not go below 9,000, then you lose your premium, just 2 rupees. So you are protecting your portfolio from sudden market crash. Uh, this is also the reason that you can see the put premium is always costlier than the call premium, because always uh, high net individuals with higher portfolio value will always have his positions hedged with some always some put options. So if you have a good uh, portfolio in stocks or mutual funds in large cap or smaller cap, you can email us at admin@gale.in to get a good hedge position where you can hedge your portfolio at lower cost. So what should you do? Whether you should buy or sell options. So if you're having a high portfolio in stocks or mutual funds, you can uh, get your collateral at 0%. Most of the brokers provide 0% interest collateral against your uh, stocks or mutual funds. So if you have portfolio worth of 7.5 lakhs to 10 lakhs, you will get closer to 80% to 70 to 80% of this value in as collateral. So closer to 5 lakhs you'll get. You can use this money to create an hedge in your portfolio by buying puts to ensure your portfolio against deep fall in the markets. Also, you can also uh, sell very low risk options, and also you can earn additional 0.5 to 1% every month in addition to the return that you get from your portfolio. So if you're a trader, if you have good capital, what you should do? You should learn some good option strategies. You should learn to read some basic F&O data. Also, you can learn some basic technical charts, and you can make consistent returns week on week. You can both sell options based on technical charts. If you feel the market is not going to move much, you can just sell some options outside the range. And if you feel the market has corrected enough and it is at a support, so you can sell the option just below the support so that it expires to zero and you get closer to 3 to 4% within few days. So if you're a low capital trader, what should you do? If you're a low capital trader and an experienced active trader in stocks and you're new to options, then you can learn technical analysis completely. So you have to learn to enter at the right time and exit at the right time. You can learn the complete basics of options trade. You can practice options with paper trading. You can start buying options with proper risk management. If you're having low capital, like your complete capital is 50,000, and just to buy more number of lots. Do not try to buy low probability trades. If some option is trading at 20 paisa or 30 paisa, and it is probability for hitting that is very low, and you do not know any technicals. If you buy it, it's just buying a lottery. Expecting it to go to 30-40 is like almost impossible. So manage your risk properly and trade. So things to do while buying options. If you're an options buyer, completely know the range of the market. Like if you're an options buyer, don't try to carry over your positions overnight. You do intraday trades initially. You should know the range between which the market is going to move. So know your target and time to enter and exit at right time. So maintain a journal where you're entering the stock and where you're exiting the options. And every time you trade, you try to gain some additional trading skills. So at the end of the day, always you analyze your trades. Be a good trader. Like you completely learn technicals. You successfully trade stocks. Then you enter options. So you should buy or should also buy the right contract. Buy contracts with higher open interest, higher volumes. Avoid buying contracts with lower volumes. You will not be able to exit at the right time, and also you will not get the favorable price. not even at the market price. As a beginner, try to trade options in only in Nifty or Bank Nifty. Avoid individual stock options. So also you know your charges, know your brokerage GST, STT, transaction charges, stamp duty, and SEBI turnover charges. One of the uh, best thing about option trade is how big ever the underlying contract value is. The STT, transaction charges, and stamp duty and all are made on the turnover. So if you're a option buyer, the STT and transaction charges, stamp duty you're paying is very low compared to trading stocks. So what do? I normally buy options based on technicals. So this is the option trades that I've done today. I bought it 9900 at 67 and sold at 75. And market moved sideways. I'll tell you the technicals. Then again I bought it at 69 and sold it at 125. So this is the view on Nifty from my Gale.in website. So this was the technical view given today early morning. So before the market opens. So we had a range of Nifty to be 9500 to 10500 as per FI data. So we had resistance at 10,000, both resistance and support. So technically it was completing the consolidated swing from 10,300 to 9550. So the current trend is bullish. It will turn bearish below 8800. So yesterday was an inside day with lows and highs within Friday's lows and highs. So once an inside day happens, breakout on either side will give a good uh, bullish or a bearish move. However, like if like based on SGX Nifty, the market was going to gap up. So we knew it is gapping up closer to 10,000. So any we had a resistance at 10,020. So above 10,020, we thought that the resistance is greatest 10,120 and 10,320. So if Nifty stays for a longer period above 10,020 and 50, then this bullish move will happen. So if it fails to move to hold above 10,020, Nifty can easily slide towards yesterday's low and beyond. So this is the technical charts. So what is this? Is like Nifty on 5 minutes chart with candlestick patterns. It is having indicators like exponential moving averages 20, 50, 100, 200, and also it is marked with swing highs and lows based on strength. This chart is from TradingView website. I trade using TradingView website charts. Uh, so I've drawn channels in it. So after the market opened, you can see the market has opened. So we were just waiting for some time so that market once it started trading about 10,120 for a longer period of time, then we thought to go long to buy 10,100 call options. So it did not happen for a long time. So this was a good bearish candle where we sold into at 67 and we booked it closer to this at 75. Then you can see this consolidated move happening. When this consolidated move happens, comes down and just tries to make double top this resistance level, we drew a pitchfork to find a channel between which the stock probably moves. So if this stock moves above 10,020, we will go long just by 10,100 calls. You can see this. So it failed to move here, so again we sold. Again we bought 9900 put over here. You can see this push happening. We should have booked profit once here. That was not done. So you can see this channel. Once this blue channel is set, you can book your profits. So you can see again the stock is trying to pull back, and this is a moving average 20. You can see it's trending down. So once this moving average is trending down and there is a reversal closer to this moving average 20, you can sell. So again we sold. This is the place where you book profits. So we did not book profit here. We were expecting the stock to move lower. So again it bounces back towards this median line. Again you can see there is a bearish reversal happening over here. So bearish reversal happening at moving average 20 and also the median line, and again markets dropped significantly. What we did is we have booked our profits over here closer to this gap. As the market filled this gap, we booked our profits completely over here, this range. What we should have done is we should have booked partial profits over here and should have either traded or could have booked some profits over here. So one trade over here has given us 6 points, and next trade over here has given us closer to 60 points. So you can see if you buy options based on technicals, you can make better returns. Also, if you have proper knowledge on FIA data, like this, if you have a range, you can just sell put options outside this range. So all that put option outside this range will expire to 0, and you can gain your small token like 1 to 2% every month. But it may sound risky, but you can every week you can change your uh, every week you can based on FIA data you can change this range and change your positions on the options. You can also book intermediate profits. Thank you friends for watching the video. Kindly subscribe to our channel, like and share it with your friends. I'll be back with a good video again.